Hey guys, this is Joey here, top tier reminder and chief trainer at Trading Impossible. So in this video, I'm going to share with you how do we determine whether the stock is in downtrend, and how low can it go in downtrend. So how do we time our entry and exit and ride the downside? Okay, so I'll just take a look at this Counter Capital Corp. It's one of the blue chips, one of the heavyweight oil and gas companies that has been hit because of falling oil prices, right? So since beginning of 2015, it has been slowly moving all the way down, okay, and you can see that the trend is clearly down, okay, since 2001, since the big, so probably in May 2015. It started to rebound in early 2015 upwards, but it couldn't, stay above that 200 days moving average. So the first way we can tell that trend is down in the longer term is to look at a longer term moving average, which is a 200 days moving average. So you can see that it kind of went up and rebounded up near this level, but unable to cross above and started to rebound back again. Right, so you can see the longer term trend is still down. Right, and yes, the prices broke below all the moving averages, especially this 100 days moving average here and that 20 days and started to move down. But how we look at it from a price action point of view is we look at the support and resistance. So let me just draw some lines over here. Okay, so you can see that there is a support over here at about 850. So it was supported around here, supported, and it broke down below the 850 level, right, in June 2015. Okay, and that's where this 850 became a resistance level, right? So it was just not able to just climb back up above the 850, and that's where we saw all the moving averages started to head downward. So as long as 850 was a resistance, then we can say that the trend is still weak. Okay, and started to hit all the way down. And the next support after 850 was what? It was about $8 right over here. You can see there's some support $8, some support $8. It rebounded, right? But at this point in time, in July, just 1 month after the breakdown of 850, in July it broke that $8 as well. And when it did, we started to see the 20 days moving average, accelerate down further, and it went all the way down from $8 to $6.30, and that's when it started to rebound. Right? But it was a really huge sell down at this point in time, right? So that was where when it break down the support, you could actually have some CFD sell positions to ride downside. So the trend is clearly down with it, breaking new lows, breaking each support on any minor consolidation, right? So it kind of rebounded back up, and we started to see a consolidation resistance at about the 750 level. So it kind of rebounded back up to 750 and then stayed up above for a while, above 720, and then started to came all the way down. But we could draw a channel resistance line just connecting this point, this point, and this point all the way. So there is a channel resistance line, and prices have always been hovering below this channel resistance line right over here, since April 2015. So when this happens, the trend is still weak, and you can see that even this line is parallel to the 200 days moving average, the 100 days moving average, and the 20 days moving average. So everything is clearly pointing down. But what is most crucial is that there was a support around the 620 level right over here. Right, so it kind of touched this channel resistance and U-turn back down to that 620 level where we saw a support. And I did issue a few sell calls. I mean, when the trend is down, we want to ride the downside, but we want to try to catch when any slight rebound up, we want to try to catch a reversal back down, or even have our sell entry on a breakdown of a key support level. So that's what we're going to do on the downtrend. So it broke below that 620 level, and it was pretty fast and aggressive sell down all the way, because oil prices actually tanked quite a lot, by more than 3 to 5%. So it came all the way down to about $5. I expected the $5 to hold, but it did not hold. So that was when if you were to sell at probably 615 or 618 to a CFD sell position, okay, you probably want to cover back along the way from probably somewhere near $6. So I would expect the $6 to hold for all, but it didn't. So if it break below the $6, you could actually increase your CFD sell position. So that's when you want to ride. So I would probably cover back position from $5.40 to $5, probably like $5.20, $5.10, and near $5. But yes, the $5 did break down as well. So we need to be careful for this counter, because what we are saying is that this $5 would be a major resistance for now. So if it were to stay below $5, it's not a good sign. So it can actually we might see some support at around the 465 to 460 level. That's where it rebounded from the low for today, but it might go back up to $5 and then return back down again, you know, with all the trend moving averages all pointing down still, right? So this $5 is a key level to watch. Unless it can go and close back up above, maintain above for a few days, then we may start to see a rebound back up to 550 to 560 possibly, right? But currently below $5 is still weak. So how low can it go? I mean, if it was to stay below $5, it might consolidate, you know, up down from 460, 465 support, temp support back to $5. But if the 460 do not hold, you know, just note that we can sit back down to $4. So that was $4 was the low we have seen in 2009. So we can use that as a gauge. You know, as that was $4 was one of the resistance in 2009. Okay, and if the $4 you know does not hold as well, you know, we can see it go back down to the $3 mark. So $3 was the ultimate ultimate low we have seen in 2008, 2009. So yeah, that's the level where we would need to take note of. So currently right now the trend is still down, especially if oil prices still falling down, right? So we need to be careful. I wouldn't encourage you to average down or to buy more at this time. I mean, unless you're really going for the long term and you have a lot of cash to really accumulate along the way, you know, probably somewhere near $4, near $3, then you can go ahead. But I wouldn't encourage you to. Normally we do not want to average down when the stock is, you know, clearly in the downtrend, because you do not know how low it can go. I mean, even if it were to go to $3 and the $3 don't hold, I mean, you break below $3, you can go to $2 or $1. So we never know. So we do not want to buy or long in a downtrend. Instead, we want to, you know, time our short positions, you know, and ride the downside more. So if you want to buy back, that's probably when you have shorted earlier at a high and you want to buy back to cover back, and then that's where you have already made your profit, right? But not to buy because you think that it will go up, or maybe if you have a position at $6.50 or $8, then you want to buy at $4.85 because you think that it's super cheap and you want to bring down your average price. But then again, you know, we do not want to do that, because you know, when it has gone down by quite a fair bit and it has broken any key support, it shows that the trend is weak. You know, it might go lower, right? So you want to be careful with that, right? So I hope you have learned something in this video, and I'll talk to you next video again. Thank you.